Hi, Matt McAleer, Director of Equity Strategies with Shaun Burgess. You know, Shaun, portfolio manager on our fixed income team. August 4th, just after close. Shaun, most of the headlines were fixed income and bond related this week, and we're going to cover that in a moment. Just a couple quick thoughts on the equity side. We spoke coming into earnings that there had been such a rip higher in tech and in growth. You tend to have a higher hurdle to get over in those earnings.
Oh yeah.
And what we've seen is decent earnings, but
really not been bad.
But much of the run had already been put in the bag. So a little bit of backstepping, you know, one step forward, two steps back. You know, when we take a look at a chart, I'm going to pop up here. This is an interesting chart, especially compared to last year, and maybe I should have popped that chart up along with it. But this is from Sentiment Trader. They're a service we use, gives us some ideas on sentiment and on analytical data. What this is showing is how quiet the market has been, particularly to the downside over the last month, 2 months, 3 months. We hadn't had a 1% drawdown in the S&P in over 40 days through the end of July.
It's been a while.
So we kind of set ourselves up just to have a little air taken out of the balloon coming into earnings. And right now, all you've seen in terms of the NASDAQ and the S&P and the Dow to a lesser extent is just a pullback off those recent highs. Now, there's a lot of comparisons made to last August when the market recovered beautifully off the spring, ran hard into early August, and then fell apart. We speak to clients and friends all the time. You can't get involved in comparing apples to apples year over year. Too many things change. The market is created from multiple puzzle pieces. And the one thing I would bet on is we're not going to see the exact repeat of last year. You know, when I'm fond of saying, you know, markets are like snowflakes. From a distance, they all look the same. When you get up close, they're all very different.
Devil's in the details.
So we'll see what the equity markets have in store for us next week. We have seen some nice recovery performance out of value versus growth. We'll see if that continues with the push higher in interest rates. So tell us about the downgrade. We always say, or we like to say, we don't care about the headlines. We care about how the market reacts to headlines. We had a big headline, got a lot of media attention, Fitch downgrading.
Did a lot of calls off of it.
The U.S. credit rating. Tell us what your thoughts are. Tell us how Cumberland is playing it, what we're thinking.
Yeah, you know, it's unfortunate, not at all surprising when you look at kind of the details and what Fitch said in their downgrade. And they really pointed to the deficits the U.S. is running, the amount of issuance of treasuries we're going to have to undergo over the next couple of years to meet those deficits, and really the government dysfunction. We saw this back in 2011. Remember, S&P downgraded us from AAA to AA plus back in 2011. So it's the same story playing out. Government dysfunction, deficits, downgrades follow. When you play games, sometimes you can win stupid rewards. And that's kind of what we got in this case, is Fitch really kind of took it to us a little bit and pointed out some of the things that we're doing wrong, and, you know, deservedly so. So the markets didn't really like that. We saw yields higher off of that. You also have, as I said, a dearth of government, or not a dearth, a lot of government issuance coming out over the next couple weeks from the Treasury. That put additional pressure on treasuries, on interest rates this week. At one point, the 30-year was up almost 30 basis points on the week. Now, we got some of that back today. It was nice to see that little rebound we got today, bringing those interest rates lower. But clearly, the market didn't like what they saw from the Fed, or from Fitch's decision to downgrade us. Didn't like what they saw coming out of the Treasury and the issuance we're going to get there. As far as Munis go, held up a little bit better. Most of fixed income was down already, but Munis really did pretty well in here. You didn't see the downside that you saw in the Treasuries. In the Treasury markets.
Different buying group, right?
Different buying group, yes.
We sometimes hear people lump fixed income together. in terms of different securities and different asset classes within fixed income. Munis, retail individual buyers.
Yep.
Treasuries tend to be not only bought globally and have large inflows, outflows, but they tend to be a big hedging instrument.
Yes.
So some of the trading in the Treasury market, when you see some extreme trading, that doesn't, flow through to our bread and butter on the muni side, and we tended to see them hold in there much nicer this week. A couple other things. When markets are a little jiggy, I like to say, I like to look at cross macro indicators. We talk about this once in a while. If there was a big credit problem, I would have expected gold to get a much better bid. It was up a little bit, not too much.
Yeah,
I would have expected to see some of the defensive sectors in the equity market get a much stronger bid. They were up. They had a little bit of a bid, especially versus the NASDAQ, but nothing very strong. As a matter of fact, if there was a big credit problem, I would have expected after a day for treasuries to rally.
Yeah, you'd see the opposite.
So they rallied off of, I guess we could call it positive job and inflation data.
Yeah, a little bit of reversion in there as well. That might have been overdone, that 20, 30 basis point move we saw in the week. It just might have been a little too much for the market.
Yeah,
So
yeah.
we got some of that back today.
So we head into August and September. We've talked about it the last couple of weeks. That doesn't mean the markets fall apart. You hear this in the media all the time. What it historically does mean is volatility gets ratcheted up. So don't be surprised to start to see those 1% plus minus days start to add up, like we saw earlier this year, or like we saw in 22, when a plus or minus 1% day was
every day.
Yeah.
It was every day.
So we appreciate you joining us. Have a nice weekend. We'll see you next Friday.